Is Bitcoin's surge to $120,000 just the beginning of a new financial era? Or are we standing at the edge of a cliff, about to witness another brutal 80% crash? Are the world's biggest financial institutions building a permanent foundation for Bitcoin, or is their hot money the very thing that will trigger the next collapse? Welcome to the debate. We're here for one reason: to cut through the noise and challenge the narrative so you can make sharper, more informed investment decisions. We believe the more we analyze and debate, the clearer the path forward becomes. Let's get right to it.
Ladies and gentlemen, distinguished judges and fellow debaters, today I stand before you to make a simple but powerful case. Bitcoin will absolutely keep going up. And I'm not talking about some wild speculation. I'm talking about cold, hard facts that are reshaping our financial system right in front of our eyes. Let me start with what's happening right now. In July 2025, Bitcoin is trading at around $120,000, meaning its value has nearly doubled over the last year alone. But here's the thing, this isn't just another crypto bubble. This is institutional adoption at a scale we've never seen before. Think about this. Bitcoin ETFs have pulled in over $120 billion in 2025. That's not retail investors gambling their lunch money. That's pension funds, insurance companies, and major financial institutions saying, we need Bitcoin in our portfolios. BlackRock's Bitcoin ETF became the fastest fund in history to reach $80 billion in assets, doing it in just 374 days. But here's what really matters: the supply story. We've already mined 93% of all Bitcoin that will ever exist. Only about 1.4 million coins are left to be mined out of the total 21 million. And get this, every day, more Bitcoin is being locked away forever by long-term holders than new Bitcoin is being created by miners. We're literally running out of Bitcoin while demand is exploding. Look at the companies jumping in. We now have 125 public companies holding Bitcoin on their balance sheets, up from just 79 last quarter. That's a 58% increase in 3 months. Companies like MicroStrategy, now called Strategy, they own over 600,000 Bitcoin. That's nearly 3% of all Bitcoin that will ever exist, held by just one company. The math is simple. When you have fixed supply and growing demand, prices go up. It's economics 101. And unlike gold, we can't mine more Bitcoin when the price gets high. The code literally prevents it. This isn't speculation anymore, folks. This is a fundamental shift in how institutions store value. Bitcoin isn't just digital gold, it's becoming the preferred digital gold. And we're just getting started. Thank you.
Thank you. Now, let's talk about what happens after the party. History doesn't lie. Bitcoin follows predictable 4-year cycles, and we're heading for a crash. Look at the pattern. 2013 saw an 87% crash, 2017 brought an 84% collapse, and 2021 delivered a 78% drop. The average? An 82% drawdown within 12 to 18 months of each peak. If that pattern holds, we're looking at Bitcoin falling to around $20,000, not exactly going up. Second, let's talk about who really controls Bitcoin. Just 100 addresses hold nearly 15% of all Bitcoin. When whales move, like the 40,000 BTC transfer we saw recently, prices shake even before coins hit exchanges. That's not scarcity driving prices up. That's concentrated power that can dump at any moment. Finally, Bitcoin is technologically obsolete. 7 transactions per second versus Visa's 24,000. Ethereum and Solana are eating Bitcoin's lunch with smart contracts and thousands of times faster processing. Bitcoin isn't digital gold, it's digital Stone Age technology fighting quantum computers and superior blockchains. My opponent talks about institutional adoption, but institutions are fickle. In February 2025, ETFs dumped $3.2 billion in 8 trading days when prices dipped. That's not diamond hands, that's hot money that will flee on the first sign of trouble. The math is simple. Historical crash patterns, whale manipulation, shaky miner economics, and technological obsolescence all point to one conclusion: Bitcoin's next big move is down, not up. Thank you.
Thank you. My opponent just gave you the classic Bitcoin bear playbook from 2017, but here's what they're missing. We're not in the same game anymore. First, let's talk about those cycles. Yes, Bitcoin had crashes in the past, but look at what's different now. In 2017, we had retail FOMO and no institutional infrastructure. Today, we have $120 billion in ETF assets, 125 public companies holding Bitcoin, and sovereign wealth funds accumulating. When institutions put Bitcoin in their 10-year portfolios, they don't panic sell like day traders. They buy the dips. Second, my opponent mentions whale concentration, but they're looking backward. The reality is institutional distribution is improving Bitcoin's ownership structure. Those ETFs I mentioned, they're spreading Bitcoin ownership to millions of retirement accounts and pension funds. We're moving from concentrated early adopters to diversified institutional holding. Third, the technology argument is missing the point entirely. Bitcoin isn't trying to be Visa. Bitcoin is trying to be digital gold, a store of value that's immutable, decentralized, and trustless. You don't need 24,000 transactions per second to be the world's reserve asset. You need security, and Bitcoin has more computational security than any system ever created. Finally, yes, ETFs had some outflows in February, but look at the bigger picture. Net inflows for 2025 are still massively positive. Short-term volatility doesn't change the long-term trend of institutional adoption. My opponent is fighting yesterday's war. Today's Bitcoin has institutional backing, regulatory clarity, and supply scarcity that creates a completely different investment landscape. The old playbook doesn't work anymore. Thank you.
Thank you, judges. My opponent just delivered the classic institutional adoption fairy tale, but let me show you the real numbers behind Bitcoin's supposed strength. First, let's address those diamond hands institutions. In February 2025, Bitcoin ETFs hemorrhaged $3.55 billion in outflows, the largest monthly exodus ever recorded. When Bitcoin dipped just 25% from $100,000 to $75,000, these so-called long-term institutional investors fled faster than retail day traders. FBTC alone lost $1.23 billion. BlackRock's IBIT shed $776 million. That's not institutional conviction, that's institutional panic. Second, the improving ownership distribution narrative is pure fiction. Centralized entities now control 31% of all Bitcoin supply, exchanges, ETFs, and corporations. The top 100 addresses still hold 14.7% of all coins. My opponent calls this diversification. But one whale moved 40,000 BTC last month and triggered a market-wide shakeout. That's not decentralization. That's centralized control with a fresh coat of institutional paint. Finally, let's talk about a ticking time bomb that no one wants to mention: quantum computers. Think of Bitcoin's security as a very strong digital lock. For years, it's been unpickable. But scientists are now building a new kind of master key, a quantum computer that could one day break that lock instantly. The scariest part? Right now, 4 million Bitcoin, worth hundreds of billions of dollars, are stored using an older, weaker type of lock. A hacker with this master key could steal it all. The fix requires a massive, slow update to the entire network. It's a race against time, and one single hack could destroy all trust in Bitcoin overnight. The math is clear. Institutional conviction is a myth. Whales can crash the market on a whim, and a quantum security flaw threatens to vaporize trust overnight. Bitcoin's next move isn't up, it's down. Thank you.
Thank you, judges. My opponent has painted a picture of fear of short-term volatility, fear of whale movements, and even fear of futuristic quantum computers. But fear is not a sound investment strategy. Let's talk about facts. First, those institutional outflows they mentioned? That was a healthy market correction, a stress test that Bitcoin passed with flying colors. What they didn't mention is that since then, long-term capital has flooded back in. The story of 2025 isn't a few weeks of outflows. It's the structural adoption of Bitcoin by the world's largest financial players. Second, they claim ETFs create centralization. That is fundamentally wrong. When an ETF buys Bitcoin, it's not one person gaining control. It's millions of ordinary people gaining exposure through their retirement and investment accounts. That's the very definition of distribution, moving Bitcoin from the hands of a few early adopters into the portfolios of the many. Finally, the quantum computing argument. This is a known, long-term challenge for all of modern cryptography, not just Bitcoin. The smartest minds in the space are already working on quantum-resistant upgrades. It's like refusing to fly on a jet today because someone might invent a teleportation device in 50 years. It's a distraction from the reality of today. So let's bring it back to the core issue, the simple math my opponent cannot refute. We have exploding demand from institutions, corporations, and even nations who see Bitcoin as digital gold. And we have a fixed, unchangeable supply of 21 million coins, with 93% already out in the world. My opponent is asking you to bet on fear and speculation. I'm asking you to bet on math. Whenever increasing demand meets strictly limited supply, the price has only one long-term direction to go. And that direction is up. Thank you.
Thank you, judges. My opponent wants you to ignore facts and call them fear. But let me remind you what the real facts tell us. Fact 1. Bitcoin has crashed 82% on average every single cycle. 2013, 2017, 2021. The pattern is crystal clear. We're not betting on fear. We're betting on history. Fact 2. Those diamond hands institutions my opponent loves, they yanked $3.55 billion out of Bitcoin ETFs in February when prices dropped just 25%. That's not steady hands. That's panic selling on an institutional scale. Fact 3. The quantum threat isn't some distant science fiction. 4 million Bitcoin sitting in vulnerable addresses could be stolen the moment someone cracks the code. And unlike my opponent's teleportation analogy, quantum computers already exist and are rapidly advancing. My opponent asks you to bet on simple math, but the real math is simple. 82% historical crashes, $3.55 billion institutional flight, and 4 million vulnerable coins. Ladies and gentlemen, the evidence is overwhelming. Bitcoin's next big move isn't up, it's down. The only question is how far and how fast. Thank you.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.